Hello, ladies and gentlemen. I'm your host, Seth Julian, and I'm welcoming you to today's session, where we're going to talk about the two essential sets of tools that sit in our bag as market traders and market analysts. Now, just to make sure we all understand, this is being presented from the point of view of a speculator. We are speculators. We're not investors today, we're speculators. Investors put their money aside in whatever market they choose and forget about it. Most of us are indeed long-term investors by virtue of our pension funds or our education funds for our children or our mortgage, whatever it is. We have funds set aside in the marketplace that we don't touch. That's what investors do. Speculators touch their money all the time in the market. They put it here, they put it there. They take it out, they take it out. They profit here, they lose there. In and out. I like to liken it to picking up nickels in front of a steamroller. Stay too long, you're going to get crushed. We live from the crumbs that fall from the table of the giants in these industries, and we make a living just picking up the crumbs, trying not to get crushed by the steamroller. Now, when we look at a market to determine what to trade, how we can perhaps make a little money, how we can benefit from a phenomenon that's taking place in the market, we have two ways to make that determination. One is through a lens, let's call it a lens, the fundamental analysis lens, the macroeconomic lens it's referred to. It means, just like the word in Latin, Greek, macro, the big picture. Macro investing, you hear macro trends. Macro simply means writ large. And fundamental analysis will explain why a graph goes up and why a graph goes down. So in order to say, speaking personally as a long-time trader and investor, I, by the way, am 65 years old. I've been trading for 52 years in the capital markets. I have some experience. I've lost plenty, by the way, but I've made more than I've lost. And that, in our business, ladies and gentlemen, is the sine qua non of success. Taking more money out of the market than you put in. For put in, you surely will. Nobody profits in this business without losing. Nobody makes any success or progress in any business without losing. The difference between the long-term success and the short-term failure is that the long-term success knows how to turn a loss into a gain. They learn from their mistakes. They don't get into the same position again. They know what to avoid. They learn what went wrong. Now, when we see a trend that looks interesting, our first objective is to explain it. Why is oil going up? Why is coffee going down? What's driving the price of First Republic Bank? What's driving the price of these things? Why are they doing what they're doing? We do a little research into the fundamentals, and that is simply a fancy way of saying, read. Open your eyes and read. We live in the golden age of information. When I started my career, the kinds of information that's available to us today was only available to people with a great deal of money and the facilities to present what at the time was the Reuters screen. In the early 1980s, when online trading started to take hold, or electronic trading, I should say, it wasn't online yet, but electronic, you had to have a Reuters screen. $2,000 a month for a screen this big that had text running across it. Now, we can get things that even the wealthiest, most powerful investors 20, 30, 10 years ago had to pay a great sum of money for. We get it for free. We have to read it, though. We have to understand it. We have to take notes. We have to have a general picture of what we think about that news. But that is how we form a fundamental idea of why the markets are doing what they're doing. And you have to make a determination. Will it continue? In the case of coffee, which was very profitable for us 2 years ago, in what first was a frost condition in the Arabica growing areas of Brazil, turned into then a drought condition the next year. 2 years, of terrible crops. Very lucrative trade in coffee. You've got to understand how weather influences field crops, etc. Just like you have to understand the fundamentals of the political economy, how it affects foreign exchange. After all, foreign exchange is the stock of an economy. You want to buy the stock of an auto manufacturer? Buy a Tesla. Buy a shares of NIO. You want to buy stock in the U.S. economy? Buy dollars. Very common approach to foreign exchange. Now, Once we have a fundamental picture of what's driving prices, whether we think they're likely to continue, we need to then determine, well, where exactly are we going to get into this position? How long are we going to stay in the position if it's profitable? How long are we going to stay in the position if it's a loss? Those determinations are often made, generally made, using technical tools. Now, all technical tools, and this is particularly important for the beginners who are obsessed with the idea that there must be some magic indicator that the big money is making, and they have all the indicators in the world on their screen, and they know everything. This is idiotic and wrong. I can design a system for you in 1 minute, 5 minutes, that guaranteed will be profitable every trade it makes. Guaranteed. Except you'll die of hunger waiting for the trade to show up on your screen. Guaranteed it'll make a fortune of money, but you probably will be dead by the time it shows up. We want a system of technical indicators that gives us enough opportunity to exploit movement, and yet gives us a sense of what the limitations are in that movement. We think this looks like a good place to get out if it's making profit. By the way, I want to make a digression here and say that we as speculators can profit going down and up. If the price of natural gas, due to some bizarre fundamentals in the European gas market, continues to plummet, we can profit from that by selling short. That's the subject of another course, of course, short selling. But when I say profit from events, they don't necessarily have to be going up in price. They can be going down in price, just as easily exploited by us as an upward trend. Now, getting back to our subject of the technical entries and exits. Particularly for newcomers, you're often brainwashed into believing that more is better. In statistics, we have a rule called the degrees of freedom, and the idea behind this is that less is more. Fewer indicators will give you more information than more indicators, because each one of those degrees of freedom limits your viewpoint so that you're ultimately looking through a little keyhole for a winning position that when it does come, you'll profit, but you're not seeing anything because you've limited yourself by so many different restrictions. The EMA has to go about this, and it goes about that, and then it does this, and then it does that. I'm in. Life doesn't work that way. It has to look good enough to potentially give you, remember, potential, this is risk. We're talking about a probabilistic world here, where we can say a certain amount of times, 8 out of 10 times, thus and such will happen if this and that occurs. But we don't know which of the 8 of the 10 times the thus and such is going to occur. So the technical indicators will show us, well, we've met resistance here before. When price gets here, we know that buyers are going to probably sell. There was a lot of buying here. That reached that point, buyers are likely to exit the market. Same with a support point. Price has gone down here, and it's tried to penetrate this several times but can't. That's resistance. That's a flaw. It's a fairly good bet that price is going to reverse and start to go up because it can't penetrate that flaw for a variety of reasons. But the technicals will show us this. It'll show us that at this particular flaw, there was a tremendous amount of volume. That's a solid flaw. Or the opposite. You look at that, there's a flaw, but there's not a lot of volume behind that. It could be easily penetrated. So you got to combine the technical and the fundamental. And this is the final message I want to leave you with. In my opinion, the opinion of many long-term trend traders, you cannot succeed without using both elements of analysis from your bag. The fundamental macro picture and the microscopic support, resistance, trends in prices, retracements of price behavior in the technicals. So with that, ladies and gentlemen, we're going to bring our session to a close on technical and fundamental trading. I'm your host, Seth Julian, wishing you all the ability to trade with confidence, ladies and gentlemen. Bye-bye for now.